So very big thank you to all of you guys for attending today. In fact, you know, I guess we are actually, as we go through this series, we are moving into more exciting, we're moving into more exciting territory right now because in the past few seminars, we have covered the basics of options. We talk about what are call options, what are put options. And right now, we are actually at a stage where I will actually want to teach you a little bit more complex strategies that will allow you to make money in any market environment. So you can make money in a bull market, a bear market. And right now, we are actually trying to learn how to make money using options in a sideway market. And once we start out this journey, I'm pretty sure that it will be very helpful for your own portfolio management, whether you are doing it professionally or whether you are actually doing it for your own investment, because more often than not, the stock market does not perpetually move up and it does not perpetually move down. In fact, there are stock market can actually stay flat for a long period of time. And that is why it's important for us to also learn how to take advantage of sideway market for us to make money. And so before I actually to start off this presentation, just a very quick disclaimer that whatever that we go through today, it will purely be for education purpose. It does not constitute as financial advice, and past performance does not actually equate to future performance. So for those of you who have not seen me before or who are here for the very first time, just a very quick introduction. My name is Kevin. I'm an investment analyst in uSMART Securities. And in my role, I actually cover the US, Hong Kong, and Singapore equities market. Concurrently, I'm also an active trader in the US option market, primarily focusing on blue chip companies and also selling options. In addition, I also provide structured product recommendation for our high net worth clients. So that is one of the segments that we basically put a lot of emphasis on as well. So today, just a very quick run through of the agenda. I want to actually share with you. Firstly, look how the stock market has actually performed historically, and I'll introduce to you some strategies that you can actually take advantage of, as well as some case study. And lastly, I will actually use a desktop version of our platform to show you how you can navigate around to sell options or buy options. Okay. Now, before I jump in, I just want to share with you, if you are interested in option trading, you feel that it may be a little bit overwhelming. I can understand, because option at the end of the day, it takes time to pick it up. But if you would like to, you can also follow our option pick. So on a daily basis, myself and the rest of the investment team in uSMART, we basically look at what are some of the attractive option trading opportunities in the market, and we will actually recommend it in our daily option pick. So if you are interested and you would actually like to get started, this is one way where you can actually follow us. And then as you get the hang of it, you can actually pick options on your own. So this is just a quick sharing on some of the things that we have recommended. So I think one of our most successful picks so far has been Pinduoduo. So we recommended actually buying a call option on Pinduoduo at the $77 price level. At the time when we recommended, Pinduoduo was just trading at $3. And I think it went almost all the way up to $7. So I think this was during a 1 week period, because we recommended on the 13th of June. And I think this price was hit within 5 days. So effectively, any investor that basically follow us, they would have gained about 100% within a week. And there are just some other picks here. I think we have Costco, Amazon, and also Palantir. Now, and with that, I like to jump in straight into today's topic, and also sharing a little bit on why it's important for any serious investor to also learn how to make money in sideway market. Because if you are just a buy and hold investor, you buy good companies like Warren Buffett, you buy and hold, you try to hold them forever. You are actually hoping that the market goes up, in the long term, which usually it does. But the thing is, even the best performing index, the S&P 500, which has historically given investors 10% annual return, they can actually stay sideways for a very long period of time. And I actually spent quite a lot of time trying to get this data just to show you that the market can just stay sideways for a very long period of time, depending, and this is backed by historical data. So this is a price trend for S&P 500 dating back to 1925 all the way back to 2017. So if you notice, there are 3 periods of time during the S&P 500 history where they actually stay flat for a very long period of time. So between 1925 to 1950s, there was almost a 30-year period where the stock market, the S&P 500, find it difficult to break above this box here. And so if you are an investor during this period, you may be actually quite frustrated because it is almost a 30-year time frame where, if imagine you bought at a peak, you are actually, you don't earn much return even after 30 years. And even then, I think there was a second time period where, within the 1960 to 1982, there was a long stretch of very flat market environment for more than 10 over years. And more recently, I think we are looking at, when we are looking at 2013 to 2016, there's a period of 3 years where the market actually stay flat. And so, as much as it is important to know how to pick stocks that will go up and also avoid stocks that will actually go down, it's important that we also learn how to make money in sideway market, because unfortunately or unfortunately, the market can stay flat for an extended period of time. And this is also why, I would actually like to introduce to you options and how you can make use of options to make money in a sideway market. So, in options, we have a couple of strategies that can help you to make money if the market stays sideways. So one of these strategy is what we call the iron condor strategy. Don't worry if the name sounds a bit overwhelming. I'll actually share with you step by step. Firstly, what is iron condor, and then I'll share with you how you can actually execute it from an option perspective. And we'll have a case study later to basically help you to get some understanding. So iron condor strategy is made up of basically 4 legs. So it consists of a buy put, sell call, and buy call. Okay. So this may seem so don't be overwhelmed by this. I will actually walk you through one by one. So the thing is, so for iron condor, we would actually need to fulfill 2 legs. So 4 legs. So you just think of it this way. From the put option perspective, you would actually buy put at a low price, this price point $90 that you think the price. So for example, you think that the share would likely trade between $95 to $105. Okay, we would actually basically sell one put option at the $95 price level to basically set your lower bound. Okay, and at the same time, we will sell the call at $105 to set your upper bound. And we will actually use put option. We will buy a put option at maybe 1 or 2 strike below this $95 price level to help us with the risk management. Okay, so just think of it this way: your buy put and your buy call is actually for your risk management. So similarly, from the sell call, we will basically buy a call option two or three strike from the $105 level to help us to do some risk management. And assume that you have a net credit of $2 for this trade, because option is for 100 shares. Your credit of $2 will actually amount to a profit of $200. Okay, so if you look at this payoff diagram here, you will actually make a maximum of $200 if you actually do an iron condor strategy. And to put it very simply, what you are betting on is that the share price will actually stay between the $95 to the $105 price level. Okay, so to simplify it, right? If you are doing an iron condor trade, firstly, have an understanding of what is the range that the share price will roughly trade. And then you will actually sell one put option at the lower bound and sell one call option at the higher bound of where you think the share price will trade. And thereafter, you basically buy one put option about a couple of strike away from the lower bound of 95, and also buy a call option a couple of strike from the higher bound to help you to limit your risk. Because if you were to basically if you do not have this buy put and buy call, you are actually doing a naked position. So you are using this to help you with your risk management. And because of that, your maximum loss at any point in time would just be $300. So I would actually show you the math later. I've tried to use a simple way to basically break it down for you, using basically using some calculation. And because you're collecting $2 of net credit, your even level will be at the $93 level and the $107, which is $2 above your upper bound and $2 below your lower bound. Okay. So just a very quick, I would just want to use some numbers to share with you how your option will perform, how this strategy will perform based on different share price. So assuming actually after you perform the trade, the share actually is at $90. This is how your option trade will actually perform, based on the different option legs that you have done. So because you have buy put at $90, your option is likely to expire worthless, since there's no intrinsic value to your option. Because if you buy put, what it means is that you basically have the right to sell the share at $90. But the fact that now the market is $90, there is no additional benefit for anyone who is holding put option to exercise the put option and sell the share. So that's why your option will actually have a $0 value. And so at the end of the day, it will be zero here. And the second leg where we actually sell put at 95, what's going to happen is that because you sell put at 95 and now the share is 90, now you are, when you sell put, you are promising to buy the share at 95, right? So you'll actually get assigned the share at $95. And given that now the share is just trading at $90, you would suffer a loss of -$5. Okay. And the third leg where you are basically sell call at 105, what's going to happen is basically that your shares will not get caught because now it's only trading at $90. So your option will have a $0 of intrinsic value. And so it is $0 right here. And the fourth leg is where you actually buy call. So what happens when you buy call is that you have the right to buy the shares at $110. But because now it's only trading at $90, nobody will actually exercise the option to buy the share. So the option will also have will also be worth just $0, considering the fact that you actually collected $2 of option premium your net P&L will actually be minus $3. Sorry, minus $3. Okay. And now what happens if the share price is trading at $93? Okay. Similarly, your buy put is going to be expire worthless because right now the share price is higher than the put exercise price. Okay. So it is $0. And your sell put, you will actually incur a loss of minus $2 because you would have taken delivery of the share at 95, but now it's just trading at $93. Okay. And when you sell call, this will be also worth $0 because basically, you know, your price is below the sell call price. So nobody will actually want to get, so your shares will not get called. Okay, and your call option, where you actually buy the call option, sorry, will actually be worth 0 as well because now it is trading below the exercise price. So considering the fact that you collected $2 of premium upfront just now, you would actually break even, you know, if you are doing, if the share price is $93 at the end of that expiry date. Now, as mentioned before, right, this strategy work best. You'll make the most profit if it is trading within the lower and upper bound that you have picked. So assuming based on the previous strategy, you pick your lower bound to be $95 and $105, you'll notice that this is where you make the most money because basically what's going to happen is that all 4 legs of your option is going to expire worthless. So let me just draw it out for you. So see this four leg here is going to expire worthless, and then you'll basically get to keep the full option premium. So this is also the reason why it is very important to basically know what is the lower and upper bound to pick for this option if you would like to do an iron condor trade. Okay, similarly, if the share price move to $107, one of the option will actually have a negative value. You actually lose money, and that is on the sell call option, because what's going to happen is that because you sell call at $105, you actually have to give up your share $105. You know, if you are just doing a sell call, right? So you actually give up your share $105, but you have to buy back a share at $107 to make up for the deficit in your share. So you actually incur a loss of minus $2. And you know, considering your option premium of $2, at the best case scenario, you would basically just break even from this trade. Okay. And this is the same case as 110 if the share price reach $110. Okay, but if we notice in both cases, your maximum loss is just minus $3, similar to, you know, the payoff diagram we've seen previously, where in any point in time, your maximum loss is limited to $300. For any price level beyond this level that you pick. So if share price actually increase beyond $110, let's say it goes to $130, your maximum loss will also just be $300. And if let's say share price actually drop below $90, let's say it goes to, let's say, $70, your maximum loss is also capped at $300. So that's why when I tried to explain previously, you know, I've said that, you know, the 90 and the 110, which are 2 price level that you choose to buy your put and buy your call, these are for your risk management purpose. Okay, because it will help you to make sure that any price above this price level that you pick, or any price below the put price level you have chosen, it will limit your loss to a certain level. And for this case, it is $300. So this is what we have for Iron Condor. So Iron Condor, effectively, if you look at it, right, it is good to generate income if a share has been trading within a range. So if it has been trading a range between 95 to 105, this is also where you make the maximum profit. And it doesn't matter. It doesn't matter whether the share price is trading at 95, 96, 97, 98, or even $100 or $105. Because of the way the option is structured, you are guaranteed to make, you will make a definite $200 if the price stay within this range. Okay, and if let's say, even if you are slightly wrong, you basically the range is slightly wrong, you pick you think that the lowest it will drop is 95, but usually drop to 93, you will still manage to break even. But just that beyond the 93 level, that's where you actually start to incur losses. But the good thing is also because you have put options that you buy at $90 and you have call option that you buy $110, you cannot get too wrong, because the thing is, even if the share price drop to $70, $60, the max you can lose is $300. Similarly, if let's say you think that the share price cannot go beyond $105, but it went all the way to $150, because of this put buy call that you have, it actually helps you to cushion some of the loss. So again, this is your loss would just be $300. So if you ask me, this is one of those trades that you actually can predefine your risk and reward ratio even before you enter the trade. So it helps you to get an understanding, what is the kind of profit I can get and how much am I basically gonna risk, which is basically if you just do equities investment, you are very unlikely to have this kind of setup. But if you were to actually do option, this is one of the interesting things that you can do. Okay. And the second strategy that I have today, right, is what we call the butterfly strategy. So similarly to iron condor, butterfly is also one of those strategies that you can use to make money in a sideways market. But the difference is that, for iron condor strategy, you can use it to generate income for yourself. So if you notice my previous slides, you will actually have the moment you actually place iron condor strategy, what's going to happen is that whichever broker that you trade with, they will give you that $200 upfront in your cash account. Sorry, in your brokerage account, they give you that $200 upfront. And then depending on how the share price move, when you close a position, then we will basically look at, what is the P&L that you are going to generate. So if you consistently can pick stocks that are trading in a flat market structure, you can generate consistent income of maybe $200, $300, depending on how successful you are, and also depending on what's the payout. So that is the beauty of iron condor. Butterfly is a bit different. It's a different animal. So when you look at butterfly, typically this butterfly setup is structured in a way that it is a net debit. So what's going to happen is that when we do butterfly, typically you would have to incur initial investment. Okay, so butterfly is so that's the difference. So iron condor is a net credit kind of trade. Butterfly is more like a net debit kind of trade. But the idea behind it is not very far off. In this butterfly setup, we also have 4-leg setup. So I will just want to share with you. So this is the butterfly payoff diagram. So for the butterfly, in this case, we are looking at 2 buy call contracts and 2 sell call contracts. Okay. So just think of it this way: when you are doing an iron condor or butterfly, just know that your those options that you are buying, whether they are call or put, they are meant for your risk management purpose, so that they limit your loss if prices go above or they go below that level. Okay. So similar to the previous example, right? Let's say I believe that the share price is likely to trade between $90 to $110. I can use this to set my risk management level, right? So these two levels, sorry, these two levels. So I can actually do a buy call at 110 and buy call at 90. So you can basically start to think of it this way. Start with, where you want to limit your risk first, and also simultaneously also think about, where the price will actually trade. And, in this case, we maybe we want to set our risk management to be 90 and $110 level. And maybe we think that, the share price is likely to stay around $100 price level. We can also sell a call at $100. Okay. So what's different, if you notice here from the previous setup, is that Iron Condor will help you to make money, the same amount of profit. Let's say Iron Condor, they help you make the same amount of profit within a certain range. But what's going to happen with Butterfly is that they will help you to make the maximum profit at the level that you sell your call. So if, let's say, you sell call, let's say you decided that the level you want to sell your call is $100 and the price is $100, this is where you will make the maximum profit. But if the price did not trade at $100, maybe it trade at 98, 99, or maybe even 101, let's say you are slightly off, your profit will actually let me just erase this first. I think it's getting a bit messy. Get the pen out. Okay. So as mentioned, for Butterfly, you make the most profit at the level that you decide to sell call. But let's say you are slightly off. Let's say you, instead of $100, in the end, the share price traded at, $97 or 98. You will actually take your profit will actually fall from the maximum profit level. So assuming that your maximum profit level is $500, it will actually drop linearly if, let's say, the price actually differ from this $100 price level. Similarly, if let's say you are off and the price went to $102, $103, the profit you will make will also basically drop linearly as well. So this is the difference between Butterfly and Iron Condor. Okay, and so in this case, similarly, the good thing, but there's a similarity in the sense that your Butterfly strategy, you can limit your maximum loss also. So in this case, we can actually limit our loss to a maximum of $500, and we will have a break-even level at $95 and $105 price level. So in the next slide, I will actually run you through the numbers and how all these profit are being calculated. Yeah. So let's go through different scenario, right? Because I think using scenario will help us to understand how your option strategy will actually how would they perform under different price environment. Okay, so I think it's important that we go through this instead of just looking at this diagram itself. That's why I always try to come up with this so that I can explain to you how your profit are being calculated. So as mentioned, this is a 4-leg kind of transaction. So you have 2 buy call and 2 sell call. Okay, and on this side is all the different price level. So assuming that after you sell you do your Butterfly strategy, the share price is actually $90, right? How would your different option perform? So firstly, we will know that, okay, your buy call is going to expire worthless because now your share price is trading at $90. So for any call option owner that actually own this call option, what it means is that you have the right to buy the share at $90, right? But since the share price is also trading at $90, there's no intrinsic value to your share. So your option will actually there's no intrinsic value to your option. So your option will actually expire worthless, right? So that explains why actually the option is actually trading at $0. And also your 2 sell call will also expire worthless because now your share price is trading below the $100 price level, there is no intrinsic value to it. So your buy call at $110 would similarly also expire worthless. So if you consider this, in this case, all 4 leg of your transaction has a $0 intrinsic value. And considering that you'll have a net debit of minus five, you actually suffer a maximum loss of minus $5 per option contract. And since each option contract is for 100 share, you would suffer a maximum loss of $500. Okay. So if you notice, one key difference between butterfly and iron condor is that in this case, butterfly usually is a net debit kind of trade. So which means that you actually need to incur initial cost of $500 to place this trade. Whereas for iron condor, the moment you set up an iron condor strategy, it will give you a credit. So in the previous example, iron condor with a net credit of $2 per contract per strategy will give you a $200 of option income. Okay. So now assume that the share price is $95. How would things perform, right? So $95, just to recap your memory, is also the break-even level. So just think of it this way. Let me see if I want my pen. Think of it this way. Previously, we talked about these two are your risk management level. The price in between this will roughly be your break-even level. Okay, so this is how we can just have a very quick and dirty way. So this is also why $95 and $105 is your break-even level. Okay, so in the case, let's say it's $95, what's going to happen to all your 4 leg of transaction, right? Because you have a buy call at $90, now if you are the option owner for this call option, right? So you have the right to buy the share at $90, but now the share is trading at $95. So your call option will actually have an intrinsic value of $5. Okay, so actually this trade, your first leg, you will actually make money. Is $5 profit. Okay, but you have a sell call at $100. You have 2 sell call option at $100, right? Which will expire worthless. So in these two will expire at a value of $0. And you have a buy call at 110, right? So this option will also expire worthless because now the share price is trading below the strike price of $110. And as we talk about, butterfly is a net debit trade. So you will incur initial investment of minus $5. And this is why your butterfly, you would at best break even. Okay. And just now we also mentioned your sell call level, this level will be where you actually make the max profit. So if you look at the numbers here, this is where you make the maximum profit of $5 per contract. And I'll just run you through again the different leg to help you gain an understanding of how you can actually generate this kind of profit. So assuming that you actually sell call at $100, right? So and the share price actually trade at $100. What's going to happen is this. Because you buy the call at $100, so you have a buy call at $90, and now the share price is trading at $100, there is an intrinsic value of almost $10 per share. Okay, because you have the right to buy the share at $90 and you can exercise it and sell it in the market for $100. So your option has an intrinsic value of $10, right? And in this case, both your sell call will expire worthless and your $110 buy call will also expire worthless. And considering that you have a minus $5 of net debit, you actually make a profit of $5. Okay. Now, lastly, I just want to talk about, what happens if the price actually increase beyond your risk management level. So let's say your risk management level is $105, right? What happens if share price increase to $110, right? So in this case, your call option will have an intrinsic value of $20. Okay. Both your sell call, you will incur a loss of minus $10. And the reason is because you sell your call at $100 and now the share price is trading at $110. So when you sell call, you are committing to sell your shares at $100, right? And because it is now in the money, you will actually be forced to give out your share at $100, even though it is trading at $110. So you would have to sell your share at $100 and buy back the share $110 to make up for that difference. So your option theoretic, so this will actually lead you to a loss of minus $10 for each of this contract. And considering that you have a net debit of -5, you will actually lose a maximum of -5. So in this case, butterfly, the similarity is that you can predefine your maximum loss. But the difference is that, for butterfly strategy, you can't really predefine you can predefine your maximum profit, but it is a bit hard to predefine, say, what is the range of profit that, you are gonna make. So it's a bit different from Iron Condor here, where, as long as it stay within the range, you'll make the maximum profit. In this case, you'll make the maximum profit when the share price hits exactly the price where you sell your call option. Okay. So now I actually want to share with you a case study on how you can actually take advantage of this strategy. So, one of the stock that I believe has very good chance to make money using this strategy is Coca-Cola. And why I say that is because Coca-Cola has been trading within a range for a very, very long period of time. I think if you have looked at this chart, right, it has been trading sideways since around October last year. October last year. So this period, it has been trading sideways since October to I think now we are in June to June this year. So it has been a good 9 months of trading within this price bound. So you see, it has finding hard to stay above $64 and finding hard to stay below $59. So if you are an option trader that want to trade sideways, this could be your upper and lower bound. So $59 could be your lower bound and $64 could be your upper bound. And then you can basically buy your options to help you do your risk management at levels above $64 and at levels below $59. Okay, so one of the trade I think it might be feasible based on this setup is using the most recent closing price is actually based on this strategy where we can buy put at 59 and then we can have a sell put at 60, sell call at 64 and buy call at 65. So with this strategy, right, basically I am using my risk management level at $59 because I'm trying to be a bit more conservative. And and the upper bound for my risk management, I put it at $65. Okay, so I use 59 and 65 to be my risk management strategy. So if you look at it, the Iron Condor will look something like this. So this is the Iron Condor strategy. So this so long as Coca-Cola share stays between 60 to 64, I will make the maximum profit. I think based on the setup, we are looking at almost 26 cents for this contract. And the maximum loss would happen when price goes below 59 and when it goes above 65. And in this case, my maximum loss is actually minus 74 cents. So I feel that, this is a good risk to reward ratio, because basically you are risking 74 cents to make 26 cents, and it is a high probability trade given the fact that, Coca-Cola has largely stayed flat for almost 9 months. So I believe that so long as, they continue to remain in this kind of range bound market, you can continue to generate income using iron condor. Okay. And if, let's say, you're a bit more adventurous, you want to do butterfly, you can actually do that also. So I would actually suggest selling put option at the mid level of somewhere between somewhere between 59 to 64, around 62 level, because I believe that the price will be somewhere in the middle of the upper and lower bound. So using that logic, I can basically sell put at $62 price level, and I can buy put at 59 and buy put at 65 to basically help me with my risk management. So if everything goes well, and let's say Coca-Cola share stays at $62, I will make the maximum profit of $2.14. But if everything goes bad and everything, and the maximum loss I will incur is just minus 0.86 cent. So even if, let's say, Coca-Cola share, out of some reason, for example, they announce a bad result and the share price really tanked, and it tanked to $55, my maximum loss will just be 86 cents for this contract. Or if, let's say, Coca-Cola suddenly announce a very good result, or maybe Warren Buffett increased his ownership and Coca-Cola shares shoot up to $66, which is much higher than the range bound market that we believe, we'll just incur a maximum loss of minus 0.86 cents, $0.86. Yeah, so this is how you can make use of iron condor and butterfly to basically help you to make money in sideway market. Okay, so before we go to Q&A, right, I just want to share with you how you can basically use this to in our platform, how you can actually sell option in case you would like to do that. So I'll just share with you I hope you can see my screen. I just want to share with you the desktop version of the app. So this is the Coca-Cola. So if you want to sell Coca-Cola options, right, what you can do is basically you can type in Coca-Cola symbol here. If I recall correctly, it's called KO. Let me try to see. Yeah, I think this is the one. Coca-Cola. Okay, so this is Coca-Cola. You'll actually bring you here. You're actually looking at Coca-Cola's share price right now. So let's see where is the option tab. So if you want to sell option, you can go to the option tab. Let me see where's options. So you can click on options. Okay, so you show you all the different options that you can have. So the call option, the put option, the different strike level, and you can click on more. So over here, they show you all the different time period. So you can sell 1 week option, you can sell 2 week option, you can sell 1 month option. In fact, you can do option all the way up to 569 days. I think that is somewhere between 1 to 2 years. So option is very fluid. There are many things you can do with it. So assuming you want to sell option, just like what we talked about, the 30-day option expiring in 28 July, you can just click on the price level that you want. For example, $62 price level, you can just click on buy or sell depending on your strategy. And let's say you want to buy, you click on the buy, and then you can basically key in the price level and the quantity. So right now, I believe for option selling, let's say for put option selling, we do support put option selling. We also support of buying call and put option. For your butterfly and your iron condor, if you would like to execute this trade, from what I recall, currently you may have to still manually add in the leg one by one. But when you do so, there is also margin reduction for such trade. So you may actually have to execute each leg on its own. Okay, yeah. So this is just a very quick sharing on how you can basically do option selling or buying on our platform. Okay. And now with that, I've come to the Q&A session. If you have any question, please feel free to ask me any question. I'll be more than happy to try to help you to understand this topic a little bit better. Yeah. Okay, so one question I received is would you recommend doing iron condor on NVIDIA shares? Okay, so basically, I think NVIDIA is one of those company where the price is very volatile. It actually increased. It actually recently increased by a lot. So NVIDIA is one of those companies where the price can fluctuate a lot, and I would not recommend doing iron condor or butterfly because very likely the share price will not trade in a range. If anything, it will either have very extreme price expectation. It could increase very quickly or it could drop very quickly. So iron condor and butterfly, just to clarify, they are good for stocks or markets where the price do not fluctuate so much. It typically trade in a range. So sectors that may be more favorable for such a trade would be your healthcare, your consumer staples, this kind of industry. I think more likely you will find great opportunities in that area. But try to avoid doing such trade on very volatile stocks because very likely the trade will work against you. Okay, the next question I see is a question on what are your opinions on selling options on index? Okay, so I think index, for example, I believe you are referring to index like S&P 500 and NASDAQ, right? So I think if you have seen the chart previously, even S&P 500, they can stay in a flat market for a very long period of time. So I believe that yes, there are opportunity in those areas. But having said that, NASDAQ and also S&P 500, the ETF is also a bit more expensive. But of course, if there are opportunities for flat market, which I believe they will exist, especially after a very big run up, we may be in a period of market consolidation before the market move higher. Yes, I do agree with you. I think there is opportunity in those areas, but just observe the market for some time. Make sure that it is also trading within a range, and also take the time to basically look at what is the range that they will be trading within before you actually execute on this trade. How does delta affect iron condor? Okay, so delta. For those people that may not heard of the term because I've not gone into option Greeks yet. So delta is basically a measure of how much your very simply put, how much your option price will actually move for $1 move in your share price. So assuming that your option has a delta of 0.5, right? If let's say the share price moved by $1, your option price should move by 50 cents. So this is basically what delta means. So the question was actually more of like, how does delta affect your iron condor strategy, right? If I understand correctly. So so to be very frank, I believe that most people, when they execute iron condor, the objective is to wait until maturity, because basically iron condor, you make if everything is going well, you do not want to close it early because you want to capture the maximum profit. So delta is more for people who want to do it, who want to basically exit your position a bit earlier. My opinion is that delta would not really affect the iron condor strategy as much as your other strategy. For example, just buying a call option or selling the put option, because basically you will have other legs that offset. So for example, let's say you sell a call, you sell for butterfly, right? Let's say you sell 2 calls and you buy 2 calls. The sell call will have negative delta and your buy call would have positive delta. So they would, the net effect is that, they would have some offsetting effect. Same for your iron condor. So when you sell a put option, because iron condor you have 2 legs, one is the put leg, one is the call leg. So you will sell put and buy put, right? So your sell put will have negative delta, your buy put will have positive delta, and your sell call, similarly, your sell call, buy call, they will have deltas that offset each other. So your sell call will have negative, your buy call will have positive delta. So in a sense, if you consider all these things in total, you will have a net, your net delta would be close. Theoretically, it should be quite close to 0. So it will not really affect your strategy. You basically, that's also the essence of being using this strategy, because you want to have as close, your delta, you want them to be as close as 0, because you are trying to not take a bullish or bearish view. You are taking a sideways view. You should expect your delta to be close to 0, and that it will not really affect your trade. Yeah. Okay. If no more questions, thank you for attending the webinar today. If you still have any further question, you can actually go to our YouTube and basically raise your question there. I will basically answer it whenever I see it. Okay. And with that, I wish you guys a great week ahead. Thank you so much for your kind support. And let's meet again, maybe in 2 weeks time or so. And I will move on to actually looking at real trading cases right now. Now that we have the theory behind us, we'll be moving on to really looking at trading opportunities. So the next few sessions, I will be trying to introduce to you different trade opportunities that I foresee. Okay. And with that, I've come to the end of my webinar. Thank you so much for being kind audiences. Okay, take care.